Crocs has soared over 400% since the stock market crash back in March. This is the CROX stock analysis. This is StockerFinance. I'm your host, David Scheuer. So let's go ahead and get into this. And as you can tell, it's over 438% since its 52-week low of $8.40 back in March when the whole stock market crashed due to a bunch of different factors going on, pandemic, a little trade war stuff going on, etc. But largely due to an economic shutdown throughout the world, not just in the U.S. as well. But at 52-week high now, $58.94. It's currently trading at $58.47. A huge, massive recovery. I mean, this is an extraordinary gain over this very short time period for a shoe manufacturing company that makes some, kind of goofy looking shoes. Pretty comfortable though, and they have a cult following kind of behind them. They're doing some really unique things with collabs and marketing that I'm really enjoying. They have a PE ratio of 26.85, so not super overvalued, although we will see that their liquidation value is significantly below what they're currently trading at. So as a value investor, that may be a little worrying, but just a really interesting company that kind of went completely over my head. I heard about this company in a news article when I was looking at, just stocks that have done well over the past few years, recovery, etc. And I saw Crocs up 430%. And I was actually listening to a podcast when I heard about it. And just pretty incredible. I think it's a really interesting story how they've recovered. And so over the past year to date, or the whole year, I guess they're up just about 66%. But with the recovery in mind, since that bottom, up 438%, just a massive return. So let's go ahead and look at the numbers and maybe we can find out why they've been able to be this successful, have this massive recovery, even though retail's really hurting right now. There's still lockdowns going around the country. But maybe their online sales are doing really good. Their revenue continues to grow. Net income continues to grow as well, which means their margins are improving. So some really interesting things here. The first thing we're going to look at is just the quarterly income statement. So we can see revenue continues to grow to the most recent Q3 2020 results, $361,736,000 in revenue. Net income, it grew to $61,889,000 in revenue. Cost of sales also grew, but just to $154,967,000. So not a massive growth in cost of sales, but we did have a pretty substantial growth in revenue. And so because of that, net income grew substantially since their margins improved there. We see gross profit growing significantly as well. If we go ahead and look at the year to date, kind of a similar story here with increased revenue, 974, almost $1 billion in revenue. One thing I want you to look at though is in Q4 2019, they actually did over $1 billion in revenue. So $1.23 billion in total revenue that quarter, with cost of sales of $613 million though. Because of that, their net income was only $119 million less than that of the most recent quarter in Q3 2020, which was $129,531,000 in net income. And that's simply because their cost of sales was so much higher than it is this quarter. It's $453,581,000, but the revenue is $974,445,000. So their margins kind of improved there, even though the cost of sales continue to increase. That's great to see for this company, and it looks like they're doing steady growth overall. We can see that with net income per share as well, both basic and diluted. We continue on here, look at cash and cash equivalents. There's a look at their quarterly balance sheet. So cash continues to kind of decrease recently. They had $151 million in cash and cash equivalents in Q2, down to $123 million in Q3. One thing you're going to see about this company is their book value is incredibly low compared to what they're currently trading at. But despite that, their revenue and earnings continue to grow. So they're obviously spending a lot of money. Perhaps they're reinvesting in marketing campaigns, etc. A lot of interesting stuff going on there. We can look into accounts receivable, which has to continue to kind of decrease over the past few quarters. So Q1 2020, $172 million in accounts receivable, which is awesome. But now it's down to $139 million in Q3 2020. Total current assets continue to grow as well. Kind of slumped a little bit as well in Q1, or from Q1 to Q3 2020, but not that big of a deal. Total assets as well, kind of a similar story there. Now $802 million and $45,000 as of Q3 2020. Significantly below, however, the market cap of of Crocs right now, which is around $3.95 billion. So it's almost a $4 billion company. But again, it doesn't mean it's incredibly overvalued. It doesn't mean the stock's going to continue to rise or it's going to start falling. It just means that, if you're a preferred shareholder and this company were to go bankrupt, you might not receive much in compensation since the book value is pretty significantly below what the company's currently trading at. But in terms of its earnings ratio, so its PE ratio, which is a price to earnings ratio, it's not that big of a deal there. And I don't know, I enjoy this company and I find this to be super fascinating. I'm sorry if I'm mumbling my words. Drank a little too much coffee today before recording this. Let's look at accounts payable here. And this is we're looking at the balance sheet. We're looking at liabilities right now. So accounts payable continues to grow. And the one thing that was a little concerning is accounts payable is growing over the past 3 quarters, but accounts receivables was shrinking. That's a little bit concerning. It's not something drastic where you see a massive drastic switch in accounts payable is growing substantially and accounts receivable is decreasing substantially, but they're both slight decreases and slight increases. A little bit to worry about there, but I wouldn't say it's the biggest deal in the entire world right now, but it is a little bit of a red flag for this company. And as an investor, you just want to be wary of those red flags. Doesn't mean it's not a good investment, but you just want to be aware of them in case something does come up in the future or in case that situation worsens for this company. And you also want to go in and find out why that's happening. Let's look at total current liabilities continuing to grow as well, which again, if we go ahead and look at total assets here, they were continuing to shrink over the past few quarters. So because of that, or the past couple quarters, because of that, it's a little worrying, but it's nothing too substantial to be super alarmed and say no to this company yet. Total liabilities, kind of a similar story there, but actually decreasing over the past couple quarters. So that makes us feel a little better about the situation at hand. Let's look at cash and cash equivalents. This is the cash flow year-to-date chart. We're looking at a cash flow or a cash and cash equivalents increasing to 126, or decreasing actually over from Q2 2020 year-to-date to Q3 2020 year to date to 126 million and 937,000 in cash and cash equivalents, as well as restricted cash. If we go ahead and look at the yearly now, so this is, we can see is the fiscal year for 2017, fiscal year for 2018, and fiscal year for 2019. Obviously, the fiscal year for 2020 is not here because the year's not over yet, but I'm really excited to see what it will be. The great thing is we can see steady growth across the board here. So revenue increased from 2017 to 2019, so now it's at 1.2 billion. Cost of sales also increased, but not too drastically. We're seeing gross profit increase as well. Income from operations, or operating income, increasing to 128 million from just 17 million. That's incredible growth there. Net income, just absurd growth. You can really tell that they improved their margin significantly, whether they increase the price of their shoes. I think one reason for this, maybe more recently, and I think we're going to see this in 2020, they did a lot of celebrity collabs, and with that, they actually are selling those shoes for, a couple hundreds of dollars or $100, and most of their shoes, we'll see here in a second, I'll pull it up, are selling for around $40, $30. Some are higher, maybe at like $100, but not crazy expensive shoes like sometimes you see with Nike, Adidas, or other companies like that. So their shoes are actually really affordable, and because of that, their margins are a little bit less, but clearly they're doing a great job with this, and they probably raised their prices slightly, or who knows what's going on, but they increased their net income to 119 million from just 10 million in 2017. That's awesome to see, and I'm really excited to see their fiscal year 2020 results and then compare it to this chart. I'll have to do another video for that. So now we can see total liabilities increasing to 606 million in 2019 from 175 million in 2017. Shareholders' equity is actually decreasing, so this is definitely a red flag in my opinion. You're seeing shareholders' equity increase pretty rapidly here, from 185 million in 2017 to 131 million in 2019. So something's going on here in terms of the liabilities. Whether they're spending a bunch of money, they're not holding enough cash, they're just keep reinvesting it into the company. Whatever's going on, perhaps they're taking on too much debt if that's going on. They owe people money, etc. Whatever it might be, there's some issue going on with the company where their shareholders' equity is continuing to decrease year over year, which is not a very good sign for this company. It doesn't mean it's a horrible investment necessarily, but it's definitely a red flag that you want to watch out for. And I'd want to see that reverse. I want to see total liabilities start to decrease or at least slow down in its rate of growth. And I want to see total assets increase a little quicker rather than decreasing, which will then create the shareholders' equity to reverse this trend and start increasing, because you do not want to have a negative shareholders' equity. A deficit in shareholders' equity would definitely be a pretty red flag, especially for this company that's valued at $4 billion. Let's continue on here. You see net income increasing from 10 million to 119 million. We already kind of looked at this stuff as well. But now let's do some quick math here. And I'm just going to do a little calculation here just to get kind of a liquidation value per share. So it's around 68 million shares, actually slightly less than that for this company right now. Current price per share is $58.58, and the market cap is $3.95 billion. Now, the shareholders' equity, how you get that is you subtract the total liabilities and total assets there. So we get $131,905,000. 68 million shares. We're going to do a little division here. We get $1.94 per share. We compare that to the current price per share. Well, it's significantly less. However, this is definitely a little bit of a red flag, but it's not the biggest deal. Keep in mind the PE ratio is just 26.87. As a value investor or a net investor, this is definitely something that you probably wouldn't want to invest in right now. Does that mean this is a horrible investment and they're not going to continue to grow? No, not at all. I actually think Crocs is doing a very good job. I'm going to show you why. I think there's some marketing moves they're doing are really good, and they can continue to kind of reverse that trend of their shareholders' equity heading towards a deficit. Reverse that trend, they'll be in a much better position. They need to start saving some more cash, maybe do some more investments on the side, etc. But they're clearly growing very quickly. I think this is a great time. It's a super interesting time for this company. Again, also all their retail shops are really closed and suffering. So they've had to change up the business model quite a bit, which maybe it costs them a little more money, or maybe they take on some more debt for that, whatever it may be. They're also paying off probably a lot of leases or different things for stores that may not be actually making them any money right now, but I'm sure their online presence has grown significantly. I know especially the second-hand market for Crocs has grown really significantly with a lot of the brand deals they've been doing with different celebrities. So liquidation value is not a huge deal, especially since most of you are not going to be preferred investors, but it is something just to take in mind. So now let's move on to why this company is doing so well. And one of the reasons for that I really like is, one, they're benefiting from the stay-at-home shift, like this article states. And the reason I'm showing you this article is because they're also collaborating with Justin Bieber and other celebrities. Now, what's really cool about the stay-at-home order is originally you would think, okay, why would people be buying Crocs right now? But number one, they're affordable, and number two, they're comfy shoes. So if you're staying at home, you don't care about wearing, dress shoes or super nice Nikes. You're staying at home, just hanging out. You just want to throw on some Crocs that you can walk around in, especially, if you live somewhere rainy, you can't just wear slippers. So you want to throw on some Crocs that are more rubberized, some, comfy socks underneath them, and you can walk around outside in your Crocs comfortably, and your feet won't get soaking wet, at least on the bottom of your foot. So that's definitely an interesting take there, and I think Crocs has benefited significantly from the stay-at-home shift because of that kind of trend towards comfy rather than dressy clothing, as well as their collaborations and their marketing tactics have been very good. So here we're looking at the collaboration with Justin Bieber, which sold out very quickly. They also priced these Crocs significantly higher than any of the other shoes they usually sell. If we can go ahead here, they did another one with Bad Bunny here, so you can just some more examples of collaborations, not only helping them market, but it's also helping them bring in more revenue since they're charging way more for these shoes. Now here, I'm just kind of threw up this little article. I was going to highlight some of it, but there's not too much here. They were saying we don't think so because in addition to fashion, the stay-at-home phenomenon and highly effective marketing are fueling Crocs, and the benefits of those trends are likely to continue through Q4 this year. I completely agree. They also had some price raises from analysts, not too big of a deal. I really try not to pay attention to those. But it is definitely other revenue growth continue. They had guiding for 20% to 30% revenue growth in the fourth quarter. So good future outlook for this company. The only thing that I really would like to see, again, is just their shareholders' equity. I just don't want to see them taking on too much liability, and I don't want their assets to continue to decrease. If they're at a shareholders' equity deficit, that's definitely a red flag for this company. So if they can reverse that trend, they'll be in a much better position, and that would be a much more inclined to invest in this company, especially because I love what they're doing with their marketing tactics, their strategies, how they're kind of changing their business model up a little bit, definitely innovating in this interesting time and succeeding overall. Now, here's just kind of a thing that I wanted to, for example, to show you guys just how their shoes are priced really cheaply and affordably during these times. You can just tell this from looking at their website here. And that's one of the reasons they've been really successful during the stay-at-home orders and during this lockdown and just whole pandemic, crazy 2020 situation going on here. But Crocs has definitely thrived. So anyways, thanks for watching. Please subscribe. I hope you were intrigued by this video. I know it was kind of random. Twitter.com/StockerFinance if you want to DM me for questions. Tweet at me, comment below if you have any other questions or comments about this video. Make sure to check out these videos as well. I'm going to do some more analysis videos. Patreon.com/StockerFinance if you would like to support the channel. It would help me out a lot. Thank you guys, and I'll see you in the next video. Peace out.